हेलो फ्रेंड्स, दिस इज रजत धर फ्रॉम फिनोजेंट और आज we will be discussing about Jyoti CNC Automation. It has been oversubscribed by around 1.33 times. So therefore the moot question is, should you go in it? Should you buy it? And what is there for a short-term investor and the long-term investor? And I will just decipher it in a very simple format, which even any other layman investor can do, just to have a precise idea whether they should jump in or not. Not only because just it has been oversubscribed. So if you see here, I will be sure. Okay, yes. So here, if we see that it was 100% subscribed on the day one, but the key factor to be known is retail investors. There were 5.22 times in the retail investor category. Non-institutional, it was 1.35 and 2.36. So one thing is for sure, there was a very high demand when only the first day has happened right now. Now the question is the GMP, the gray market premium today is 95, which technically means that when it gets listed at its highest listing price of say 331 rupees, so it might actually get listed at a premium of 95 rupees. So more than around 22% would be the listing premium, and maybe that is the reason why the people have been jumping in. But what is the strength of the stock? So let's dive something deeper into it. It is among the world's leading manufacturers of CNC machines. It is world's 12th largest with 0.4% market share, while as in India, it is having 10% market share and is among the third largest in India. While it is a leading manufacturer of also 5-axis CNC machines in India and turning machines, turn mill centers, so on and so forth. And many leading brands and companies actually use their machines in India. Today, the date of opening, when we talk about issue details, today on 9th of January, the IPO was open. 331 is the maximum price band that it has got. It has already been 1.35 times subscribed totally. Now, if we come here, we know that they are partly using around 475 crore for the full or part payment of their borrowings. So that means they have certain borrowings and they want to pay that off, and the rest would be used for the long term working capital. Okay, there might be some productions going on, but they have long term working capital. The promoter and promoter groups holding from 72% to around 62. The problem arises when we look into the key financials. Key financials, if we look at between financial year 21, 22, and 23, if you see that the revenue has increased, the EBITDA has increased. However, if you see that adjusted profit after tax, in none of the year it has made a profit. So it has been totally a loss-making entity if we see the 3 financial years. And with that thing, return on equity was as low as minus 18.8% if we look at financial year 2023. In 2022, it was over minus 117.4, while the debt to equity currently is at 10.2. So debt to equity means it is highly leveraged. So therefore they might not be having too much funds to even cover their short term or the long term debt, and maybe that is the reason why they are coming up with this IPO. Now here one more point is to be seen. They are coming up with around over 85 PE ratio as we see it. So that means it is coming at a very pricey valuations. If we see further into it, into the cash flow and the ratios, in this segment we talk about the cash flows and the ratios. Between financial year 21 to 23, the cash flow from operating activities has actually declined. So between 22 and 23, if we see that it has actually not made money from the operating activities. So operating activities are the activities through which the company make money. So if I'm in a paper manufacturing company, how much paper do I print, whether I am making money or by printing the paper or not? There might be other expenses that might come out of it. So therefore, for a company to be stable, we have to see that the cash flow from operating activities has to be improving. That will show that the company is optimizing its resources, and it is profit making enterprise. It supports into the profit making enterprise. So therefore, the net profit does not depend too much on the sale of other assets. So now the cash flow from financing activities has substantially increased. So therefore, if we see the free cash flow between 2021 to 2023, there has been a negative free cash flow. So that means it is not generating cash profit for investors. Its return on assets is just -1. For any company to be very good investable, normally the return on assets should be 4 or more than 5. So that means how many times you are actually using the assets to actually utilizing the assets to make the production. So therefore, higher the return of assets, higher much better it is. And if we see that the return on equity, we have to be more than 50, and here it is -18.8. So even if you have to consider investing into any company, if the company is not having an ROE of around 15% or above, it does not qualify to be a good candidate for the investing. So that means you then are more speculating on it based on the trend or the euphoria rather than on the financials of the company. So when we look at the margins, we can see that the margins have been improving, but however, it has been highly leveraged company, and that is where we have to see. Gross margin has technically decreased here. The gross margin has decreased. They have worked here on certain depreciation part, due to which the net income margin, if we see here, has improved in reference to the previous financial year. Now, therefore, when you say that, okay, you need to go for Jyoti CNC, you have to make apples to apple comparison. And if we see that it is being listed at 331, and we know that it will be listed at 95 rupees premium if the same stands for the next 2 days. So that means at around say 400 bucks it will be listed. And here other companies are at 536, 13,000 rupees share, 421, so on and so forth. But the point to be mentioned is, here if you see all the companies adjusted profit after tax, all of them are actually a profit making company except Jyoti CNC. Now, if we go through the market capitalization, it is just 7,527 crore company, which we can say that it is it comes in the bottom 3 among the competitors. So therefore, it is also not that big a company. And if we see at the what we say that adjusted profit after tax margin, it is just -1.7%. Price to earning ratio, it is actually coming at around 85.6%, and the price to earning will be too high for it. So the PE ratio, if we see others, they would be around 23, 17, 21, 16 and 14, which makes them more and more return on equity, it makes them more and more a good contender for investment. So even if in the Mac power CNC machines, if you see that, you might say that, okay, it is a borderline case, I can exclude that. But still, even if you want to make an investment judgment randomly, with if for example you are following a trend, so you will see that, okay, how much is the ROE is 16.9, 21, 17, 23. So you can make a selection based on of it, but you also want to make sure that you do not pay too high a price for the returns you are looking to make. So therefore, you will look at the price earning ratio. Price earning ratio here, if we see, 69 is the most costlier, 38 is the lesser than this, and 45 is a bit comes in the medium range. So you will say, what is the trade-off between ROE and a PE ratio I can have amid various other factors, technical charts, cyclicity, other financial details. So you have to make a trade-off. If I want to invest into this segment and there is Jyoti CNC automation coming, should I invest into this as an investor, or should I go into other competitors with highly leveraged at short term and the long term debt, with debt to equity ratio of 10 times? So that is actually a strain on the company. So therefore, if we see the high valuation, CNC automation is highly priced by its PE and even by EV by EBITDA ratios. If we say growth potential versus risk, it shows a potential for the growth and recovery, but it comes at a significant risk. Its interest coverage ratio covers hardly 1 time its debt. Interest coverage ratio is how much of the interest you are able to cover with the cash you are actually having. So therefore, the high IPO valuation requires strong future earnings. So this would be possible, the growth potential will be possible if it is having a very strong growth in sales and is able to beat the competition hands down. Then we talk about the market position. It has a smaller scale of operations, it is less profitable. So therefore, if we see its oversubscription on the day one, we say that gross market premium of around 95 rupees still at the end of the day one. That means those who are speculators, those who wants to make the listing gains, may try to jump into the stock and go in and come out if you get allotted. Since it is an oversubscription, so the lucky ones would get only one lot, which will amount to around 4,000 rupees. So therefore it is not too high an amount that would make any tangible benefit to the investors. However, it is just, you say, pump and dump. It might be good for an investor if he pumps and dumps. He gets the allotment and within a day or two or three, he sees the swing and he sells it up and he makes a decent profit that comes with it. But if you're an investor and if you want to go very long in it, I think there are much better players in the same industry available. So this is Rajat Dhar signing off. So this is a very simplified way of analyzing the IPOs, and just rather than getting into the FOMO of the IPO aaya hai. So similarly, when you go for an IPO, just don't go on the oversubscription and other things. You also have to see on the long-term perspective if you are an investor and not a trader. Thank you so much. It is Rajat Dhar signing off.